The economy is a vast, intricate system, one that shapes every aspect of our daily lives. Yet, beneath the surface of news headlines and market reports, there are secrets about how the economy truly works. Insights that, if understood, can transform the way you invest and manage your financial future. Today, let's uncover 10 of those secrets, the very principles that guide the decisions of the world's wealthiest investors and influential institutions. By mastering these fundamentals, you'll gain the clarity to ride the economic waves and make smarter decisions for your wealth. First, let's talk about the economic cycle itself. The economy doesn't move in a straight line. It operates in cycles. These cycles, often called expansions and contractions, are periods of growth followed by slowdowns. While they may seem unpredictable, they are actually carefully regulated by two powerful forces: the government and the central bank, specifically the Federal Reserve, often referred to as the Fed. Understanding that the economy moves in these repeating cycles is crucial. During expansion, companies thrive, jobs are plentiful, and investments tend to yield strong returns. But during contractions, things slow down. Unemployment rises, spending drops, and asset prices can fall. The key is to recognize where we are in the cycle and adjust your investment strategy accordingly. Now, what does the Fed actually do to manage these cycles? Here's the second secret. The Federal Reserve wields a powerful tool: the ability to adjust interest rates. When the economy overheats or inflation rises too quickly, the Fed will raise interest rates, making borrowing more expensive and slowing down economic activity. When the economy struggles and growth stalls, the Fed lowers interest rates, making borrowing cheaper and encouraging spending and investment. But how does the Fed decide when to act? They monitor several critical indicators, including the Consumer Price Index, CPI, which measures inflation, non-agricultural employment rates, which signal job market health, employment subsidies, and the Industrial Purchasing Managers' Index, PMI, which reflects the state of manufacturing. These indicators reveal whether inflation is under control, if jobs are plentiful, and whether manufacturing is expanding or contracting. The Fed's decisions ripple throughout the economy, affecting everything from mortgage rates to the performance of stocks and real estate. Third, don't underestimate the government's role in shaping economic trends. Governments are major players in pushing money into the economy through public investment projects. When you see highways being built, railways extended, large seaports developed, or airports expanded, that's not just infrastructure, it's economic stimulus. Industrial parks like Silicon Valley are another example, creating hubs for innovation and manufacturing that drive growth. Governments also regulate tax revenue, offering incentives to companies to expand production and create jobs. These policies can dramatically influence which sectors thrive and how quickly the economy grows. And when governments need to fund these projects, they issue government bonds, essentially borrowing money from the public to invest in the nation's future. Understanding how public investment and fiscal policy work gives you insight into which sectors may see a boom and where you might find lucrative opportunities for investment. Here's the fourth secret, and it's one the super rich know well. When the Fed decides inflation is under control and wants to stimulate growth, it gradually lowers interest rates. Suddenly, leaving your money in the bank isn't as profitable. Returns from savings accounts shrink. Investors and financial sharks begin shifting their cash into riskier investments that offer higher returns, such as stocks, real estate, gold, Bitcoin, iron and steel, basic materials, and consumer goods. The flow of money into these assets can drive prices higher and create investment waves. If you recognize this trend early, you can ride the wave and profit as the economy expands. It's not about luck. It's about watching for signals, understanding the movement of cash, and acting with confidence. But here's the fifth secret, one that's equally important. The economy isn't immune to crises. When production ramps up too quickly and supply vastly outpaces actual demand, trouble brews. Factories churn out goods, but consumers aren't buying enough, leading to oversupply and falling prices. If unchecked, this can trigger an economic crisis. The Fed steps in by raising interest rates to make borrowing more expensive, encouraging people and businesses to save rather than spend. This draws excess money out of circulation and slows down production, protecting the economy from collapse. Recognizing these moments when supply overwhelms demand and the Fed tightens monetary policy is essential for avoiding losses and even profiting by shifting your investments to safer assets. The sixth secret is psychological. The super rich, top investors, and market sharks don't want the average person to understand these cycles. Why? Because knowing when to buy, sell, or hold is the difference between accumulating wealth and losing it. They watch government policies, Fed announcements, and economic indicators, making moves that seem mysterious or risky to outsiders. But these moves are calculated, based on a deep understanding of how money flows through the economy. Seventh, it's vital to observe the investment waves created by these cycles. When interest rates drop, money floods into stocks and real estate. When interest rates rise, cash flows back into banks and government bonds. By tracking these waves and positioning your investments to follow the general trend, you can gradually build wealth. It isn't about chasing fads or taking wild risks. It's about moving with the tide, not against it. The eighth secret is about personal finance. Limit your use of credit cards and avoid spending beyond your means. Economic cycles can be unpredictable, and debt can become a burden if the cycle turns and income drops. Super-rich investors often leverage debt strategically, but they also maintain the discipline to pay it off quickly and avoid getting caught in a downturn. Ninth, diversify your sources of income. Relying on a single paycheck or investment can be risky, especially when the economy shifts. The most successful investors and entrepreneurs build multiple income streams, whether through side businesses, rental properties, dividend-yielding stocks, or other ventures. This diversity provides a safety net during economic contractions and multiplies your earning potential during expansions. Finally, the 10th secret, stay informed, but remain sober in your decision-making. Don't get swept up by hype or panic. The economy will always have ups and downs, booms and busts. By staying calm, watching the signals, and making strategic moves, you'll be better equipped to capitalize on opportunities and protect your wealth from unnecessary risks. To summarize, knowing how the economy truly works isn't about memorizing complicated charts or following every headline. It's about understanding the fundamental forces, the cycles regulated by the Fed and the government, the impact of interest rates, the significance of public investment, and the psychology of big investors. When you align your investments with the general trend of the economy, you position yourself to grow your wealth steadily, even as the world changes around you. Remember, this knowledge is powerful. It's what separates the few who consistently build wealth from the many who struggle to keep up. If you found these insights valuable, continue to educate yourself, observe the signals, and invest wisely. Wealth is not built overnight, but with patience and understanding, you can ride the economic waves to financial success. Thank you for joining me on this journey. Stay tuned for more strategies and secrets to unlock your financial potential.